composed of neighborhood stores in a quiet downtown setting. The introduction of mass-produced automobiles brought thousands of people from San Francisco to find a piece of the American dream. Along with the people came the factory stores and the mass merchandisers. In this tough business environment, many good business owners get into trouble. That's where I go to work. I carry a calculator. It was Monday, February 13th, 8:30 a.m. It was warm in Vacaville. We were working the day watch out of accounting. My partner is Bill Gannon. The boss is Captain Adams. My name is Friday.
The story you are about to see is true. The names have been changed to protect the innocent.
Yes? Oh, I see. Oh, not that I know of. All right. We'll be down there as soon as possible.
Trouble?
Yeah, we've got a cash emergency down in Oakland.
How long can they last?
Not long. We better go now.
What seems to be the trouble?
No money.
Where is it?
I don't know, it's just gone.
Well, what about the cash drawer?
$35.
Oh, checking.
About 45 overdrawn.
Well, you have to fall back on your savings.
That's long gone. You know, I don't know what the deal is. I'm a hard-working guy. I work 6 days a week. I got a good crew. I sell a decent amount of tires. Money's just gone.
Thank you for calling Nova Tires. This is Bonnie. Just a moment, I'll check. It's Christine Hanna.
You know, I got bills to pay, I got tax collectors down my back, I need some help.
Hold on. Maybe we can help. Can't. Why don't you go somewhere where we can talk?
Okay, like I said, I'm pretty damn desperate. Bonnie, can you handle things for a few hours? I'm going out.
I'll
Go.
take her, babe.
Yeah, come on, Tom. Here, the car's ready.
The rotation valve is free and the oil change is $24.90. Oh, okay, good. I have that one. Great. Thank you. Thank you. Bye. Good morning.
I need a job.
Okay, you'll have to talk to the manager. Slide to the front office, please. Slide to the front.
Yeah, what do you want?
Looking for work.
You're looking for work?
Yeah.
You have any experience?
Sure, I got lots of experience. I worked at all of them. I worked at Goodyear, Firestone, Headquarters, Discount.
Oh, yeah?
9:35 a.m. The waiter had just poured our second cup of coffee.
You see, this is what I don't understand. Look at this P&L deal. It says I made $45,000 in '94. I don't have the money. The IRS is going to want me to pay taxes on it. You know, this thing's got to be wrong. This damn crap the accounting department produces.
We can explain that to you later, Tom. But first, we have more questions. You said you bought this store in '94 from Don Riddick. How much did you pay him for it?
You got a killer deal, $250,000.
And did you look over the books before you got the deal?
I was Don's manager for 8 years before I bought the store. I run the store the same way. Got the same crew, same amount of hours. You know, we sell the same mix, same DNA.
Well, did you refigure the break-even point once you took over?
Not really, why should I? I mean, everything's great. We're up a percent or two for the year. It's looking good.
But Riddick could pay his bills and you can't, so what changed?
Nothing changed. I'm sitting here trying to pay my bills and that butthead's in Santa Fe or something and he's getting checks twice a month.
Well, that's it, Tom, you just answered your own question. When you worked here and Don was the manager, was he sending a check every month to the old owner?
No, he already had the place for like 10 years. He bought it back in '75. He bought the property back in '80. And now the property is worth a heck of a lot more than what he paid for it.
What kind of rent did Riddick pay?
You're not listening to me, are you? He owned his property. He had no payment. It was free and clear.
So does your rent payment match his mortgage payment?
Not really. I mean, I'm paying based on the fair market price right now.
So you pay more rent than his mortgage?
Well, yeah.
Well, don't you see how that made your break-even point go up? And what about your purchase price? Did you pay him the $250,000 in cash?
What do you think? What do you think I am, Steve Cloward?
No, Tom, you're much better looking.
You're damn right. I mean, he's a pretty sorry bastard, isn't he? But we're not gonna really get in. Let's get back to my problems. Anyway, I paid $25,000 down and I carry a note for the rest.
Well, were there other notes on the books when you took over?
Well, let's see. We bought a piece of alignment equipment. We leased that. Typical bills. I owed CPW lots of money. Big O, a little bit of money. Nothing was really overdue, though.
Well, even though you were not aware that a lot of things changed when you took over, and also you paid a lot more for the store than you think. Why don't you listen while my partner prepares your '93 and '94 financial statements?
If you want to look, the first few pages of the handout, I put Tom's financial statements there. Let's start with the purchase price. Okay, Tom, you paid a down payment of $25, and you pay on a note for $225. So you paid $250,000 to Don, right? But your purchase price. Here's what it actually was. You paid Don $250. You took over his accounts payable for $42,000. You took over his taxes payable for $8,000 and his note to Textron for $30,000. That means you paid $330,000 for the store. But let's see what happened to your break-even point. On page 5 of the handout, there's a detailed calculation of break-even point, but in general, it's the total expenses minus the gross profit percent. And what we want to look at primarily is what changed when Tom took over the store. I just wrote down here the primary things that changed. Tom pays rent $5,000 every month, but when Riddick owned the store, he didn't pay rent, but he paid an SBA loan for about $4,700 every month. Tom pays Riddick $3,800 every month on a note, and he took over the Textron note that they just got before this store sold. That means there's a difference every month in cash flow of about $4,900. And you divide that by a lower gross profit percentage. Tom, do you know why your gross profit went down between 94 and 93? Because you weren't taking your discounts. That means your gross profit went down and your break-even point went up.
Well, what I don't understand is where's my $45,000?
Your money that you made last year, it's here.
What?
Your money's here.
Where?
Well, if you look at page 1 of the handout, it compares the balance sheets from the beginning of the year to the end of the year. And if you go like this and look down and compare everything except cash, it'll give you a clue as to where your income went. For example, on accounts receivable, at the end of the year they were $15,000. At the beginning of the year, your accounts receivable were $2,500. That means they increased by $12,500 over the course of 12 months. How do you think that affected your cash?
I can't keep up, I don't know.
Okay. If these customers had paid you cash, would you have more cash?
Yeah, yes.
So when your customers pay on account and you hold a lot of accounts, it means you're paying, they go for product, but your customers aren't paying you. And that hurts your cash.
Right.
Right. And if you look at the bottom half of the balance sheet, the effect is almost the opposite. When the balances decrease, it affects your cash. For example, the Textron note, at the beginning of the year it was $30,000, and at the end of the year it was $22,000. So the amount that you paid down, what did that do to your cash?
You did a terrible thing.
Yeah, so that's where your money is.
That's
You sure do have a beautiful family, Mr. Adams.
Well, thanks very much, Bonnie. By the way, I'm sorry I couldn't pay you today.
Oh, no problem.
If you just put it on my account, then in a couple months I'll be in for that free rotation.
All right, we'll see you then.
Come back yet?
No, why?
That new guy I hired back there, he's just driving me crazy. Anyway, I haven't had lunch yet. You mind go get me something to eat?
No, no problem.
Really, you need any money?
Yeah, please.
Well, here, let me get it out of cash drawer.
I owe you a dinner.
Oh, yeah, you bet. Oh, here.
Keep an eye on the time, but don't mess with my paperwork.
Not me.
This is Daisy Duke from Castle County. It's so hot here in Georgia. Sorry that I'm breathing hard, but Boss Hogg has been chasing after me, cousins. It's so hard to run in these high heels. My legs are so tired. They're just throbbing.
Excuse
It
me,
would be
I have a real important
so
phone call. Just a minute.
nice if you could massage my long legs.
Come out here and handle this
Do you
order for me,
have
please.
strong
Why don't
hands?
you handle this order?
I
I'm an important phone call.
love a man with strong hands. I love a man with strong hands and a fast car. I bet you have a fast car. I bet your car is so fast it would just rip our clothes off. I love it when clothes ripped off.
Yeah, thank you for calling Big O Taxi. Oh, nothing really. See, an order came in, yes, it did, and other than that, everything's just fine. Handle it, would you?
Yeah, did you count the tires?
Yeah, I did. I counted every one of them.
Did you check brand and size?
I checked brand and size, everything's fine. Just go ahead and pay it.
Yeah,
When you first bought it, were your finances tight?
Oh yeah, my wife and I had to watch every penny.
But it's okay now, isn't it?
It's fine. You know, we got the place fixed up a little bit. Both of our incomes have gone up a little bit. It's okay.
Well, being the new owner of a store is just like being the new owner of a home. At first, your expenses are kind of tight, but like in 6 years, you're going to have Riddick paid off, and then things won't be so bad for you. They won't be so tight.
Yeah, but if I can survive 6 years.
I know you can. If you just work a little smarter. You've got to set new sales and new expense goals for yourself that are compatible with your new higher fixed costs.
Can you guys help me with that kind of stuff?
Of course we can. That's the beauty of using a computer program to prepare your 95 budget. Because together we'll try various options on paper, such as increasing sales or gross profit, or reducing expenses.
And this will give you a good feel for what you need to do. It allows you to choose the option that you feel the most comfortable with.
Can you guys help me with the expense part?
Well, every year we publish an average financial statement for all the stores that we work with, so we've got a good guideline to work with.
Yeah, you can compare the expenses of your store with the expenses of average, and then make a judgment call as to whether that expense can be reduced or not.
For example, it looks like your phone expenses are really out of line.
Have you reviewed your phone bill lately?
Well, Bonnie pays my phone bills.
Well, if you don't look at your bills, then how do you know which expenses to cut?
I guess I really don't. Well, thanks guys. I promise to do my homework by next Monday. We have our meeting on finance.
Okay.
Right. There is one more area that we think you need help in.
What's that?
That's in internal controls.
Internal controls.
Yes, internal controls is an accounting term for controlling employee theft.
Thanks.
Yeah. Thank you.
Well, Bonnie, I'm back. Have you ever heard of internal controls?
No, that sounds like some kind of disease or something.
Yeah, I gotta talk to Clyde.
Internal controls means doing a lot of little things on a regular basis.
You make these practices part of your daily routine, so you don't even have to think about them.
For example, you need to take an account of all your sales invoices at the end of every year, or you might have trouble.
And to avoid employee problems, you should have specific hiring procedures, like get a written application and check references before offering some yo-yo a job.
Also, as much as possible, you want to try to separate the duties for handling cash, accounts receivable, and sales between you and specific employees.
Always review your bills before you pay them, and make sure you pay only for what you get, and establish priorities when cash is tight.
Also, keep house charges to a minimum, because you can't pay your bills until your customers pay you. You know.
Even if you don't have a computer system, there are ways you can track your inventory, and there are some suggestions in your handout. You know, if he figures this out, we're in big trouble.
Hi, Arlene, we're back. Any messages?
I'll say, well, you were out with that 7 phone calls, 5 letters, 1 fax, and some email.
Just give us the fact.
The story you have just seen is true. The names were changed to protect the innocent.
On Monday, February 20th, a budget meeting was held in the accounting office in Vacaville, state of California. In a moment, the results of that meeting.
This is Tire Talk. I'm the tire guy. Folks, today I'd like to talk to you about Big, because I truly understand Big. Big O Tires has asked me, the tire guy, to tell you about one of their biggest offers ever. This week, buy a set of 4 Big O Bigfoot AT or XT tires, and you'll get 2 free tickets to the U.S. Hot Rod Grand Slam Monster Jam at Arco Arena, presented by Big O Tires on January 27th and 28th. See? Big. Bigfoot tires from Big O and free tickets to the Big Monster Truck Show. It's a big deal from the tire store with big cost-you-less savings every day on a big selection of big brand-name tires. In fact, Big O will give you a $3 off adult ticket coupon to the Big O Tires U.S. Hot Rod Grand Slam Monster Jam on Friday, January 27th, just for asking. No purchase necessary. Now that's big. If it were any bigger, it would be, well, bigger.
Reputation you can ride on big old tires.
Big O for good.
After refusing to follow the new internal control procedures, Bonnie Silver was dismissed from her employment. She is now working at the Big O store owned by John Adams in Denver. Bud Bailey now attends every manager's meeting and is a regular at all training classes. He was selected by the Trenmore Tribune as one of this year's 10 best managers. After returning from a weekend ski trip, Brian remembered that he had hurt his back at work the previous Friday. He is currently collecting workers' comp and unemployment.
Tom spent some quality time setting goals for his store. He set reasonable sales goals and watched his expenses. He negotiated a longer payment schedule with Don, got off COD and pays his bills just in time to take his discounts. And his employees are now so well trained, he only needs to work 5 days a week.
Well, that concludes our short skit and real-life drama. First of all, how about a hand for the one thing I'll give credit where credit's due. Marjorie put the whole thing together. I know she comes from your part of the country.
Thank our volunteer, Tom, for being such a good sport.
It's easy when you're better looking than Steve. Included in the handout, and I don't know the exact page numbers, but as you saw up here, there are a number of problems that can happen very easily in your store, from invoices being torn up. I don't know how many of you saw the 2 tires get rolled out the back door, concern we all have every day. Okay. Page 13. There are some real-life examples that I had sent a note out to the dealers probably 4 months ago and got a number of responses from dealers confidentially talking about real-life problems that they had experienced, what they finally saw, what led them to that particular type of problem. Low gross profits, as this skit demonstrated, not enough cash, all of a sudden bills are due, you can't pay them, losing discounts. There's a whole host of things that are described in the skit and also in the handout, so you might want to take a look at those. I think the thing that we want to underscore, and I think you guys in the Western region have the premier example, is the services that you can get from your regional accounting corporation or trust, whatever name you use for it. But here you have a qualified team of people that are there to help you every day, work through internal control issues. It's really not a disease, but it's one of those things in business that a lot of people talk about, not a lot of people understand, but really what it gets down to is just doing things that are common sense in your store. Just to make sure that things are running the way you want them. And certainly the people at any of the regional accounting corporations will do whatever they can to help you in that regard, including coming out to the store, helping you set up files, and working through control issues. The other thing I wanted to mention with regard to the regional accounting corporations, and I doubt that this is really an issue in the Western region, but in the last couple of pages of the handout, we've been working on a standard chart of accounts and also standard financial statement formats. Now that becomes fairly easy for the folks in the Western region because what we really did is just adopted what you all had put together anyway. Marjorie, I think with your help, we did make some some modifications, mostly in the sales categories. But that is in good shape right now. And what we're trying to move towards is the ability to capture comparable information across the country and share it amongst the dealers, which I know that you're already doing in the western region. At this point, I'm going to ask Phil Tigan, company's general counsel. Phil, the gentleman that couldn't get his wheels because he was a day late with his coupon, and also Joanne Bora. Joanne, many of you know from, started out with us in Northern California, is now up in the Northwest region. We've asked them to talk about limited liability companies, so I'll turn it over to them.
Morning. Morning. A new development in law has occurred just recently, which I think is would be of real interest to a lot of you. It's a new form of company or business entity. We all know about the traditional ones, the sole proprietorship, where there's no business organization. You do business as a person. It's good for tax from the tax side in that you are only taxed on your end. It's not very good from a liability side since you're what we call naked legally. Then there's a partnership, and then there's two of those, general and limited. And two people can come together and start a business organization, I suppose, for their investment. But there's a big proviso with that, and that is that you can't be involved in the management or affairs of the business. You have to be completely silent, sit back and relax and watch your money grow or not grow. Then there's a corporation. Well, a corporation does give you limited liability, and it does protect you, but then you have the reverse problem, which is taxation, double taxation. You tax the corporate entity, and then the dividends are taxed and they're distributed to the shareholders. It's interesting to me that this new type of company came out of Wyoming in 1977. It is a common type of company that's been used in Europe and in South America and so forth, but in 1977, Wyoming passed the Limited Liability Act, and it kind of sat there and it wasn't used very much except for a few Wyoming residents. But about 10 years ago, other states started looking at this. Florida adopted it, and today I think there's 46 states that now have a Limited Liability Company Act. All the states in our system have Limited Liability Acts, so this is available to everybody in our system. Joanne's going to go into the benefits of this kind of company. The best way to sum it up, though, I think, is to tell you that it gives you the benefits of a partnership as far as pass-through tax benefits, but it also gives you limited liability. And so it's combined, if you will, it's combined of the good traits of a partnership with the good traits of a corporation, and that's what we have here. So I'll pass it to Joanne.
Each one of you, when you went into the tire business, had to make a decision about how you wanted to operate the store for tax purposes. Until recently, you had four choices. You could be a sole proprietor, or a C Corp, an S Corp, or a partnership. Now you have a fifth option. In California, you do limited liability companies. I've given you two handouts. One of them is entitled Choice of Entity, and it has some considerations that you need to, things you need to look at before you make a decision about what type of entity you want to operate under. The other one says Limited Liability Companies, and it's an elaboration on some of the things I'm going to talk about in the next couple minutes, so you can use this as reference. As Phil said, a limited liability company is a hybrid. It operates in a similar manner to a partnership for tax purposes. The income flows through to you and it's taxed at your level. But it also offers the protection of a corporation so that you no longer can be sued personally, the corporation is sued. The limited liability company attempts to give you the best of both worlds. If you want to be a limited liability company, there are some advantages over an S corporation. And I've listed some of the advantages in the handout. There are also several disadvantages, and you need to take a look at that before you make a decision. What I would like to stress, though, about limited liability companies is the flexibility they offer. Basically, they offer flexibility in formation. You can have many classes of stock. You can have voting stock, non-voting stock. You can have preferred stock, preferred as far as income, preferred as far as capital. None of this is possible with an S corporation. You also can have flexibility as far as allocations of income. You can allocate special types of income to certain partners or members and not to others. This, again, is not allowed under S corporations. You also have flexibility as far as debt financing, and you can't do that with S corps. You also have flexibility in tax deferral opportunities. And again, this is not available to you as an S corp. And generally, there are no tax consequences upon dissolution of the limited liability company. And again, that is not true for S corps. As always, if you decide to look into becoming an LLC, you need to talk to your local CPA, your local accountant, and maybe some other dealers that are already operating as one. And every state has its own statutes. You need to be aware of that. But I would like to encourage you to consider a limited liability company as a viable entity for your store. If you have any questions, I'll be glad to talk to you afterwards.
Thank you, Joanne. The next subject we want to talk about is business succession planning and estate planning. One of the things I think we've all done in here in order to get into business is we spent a lot of time planning on how to get into business, or how to make more money each year, or how are we going to be able to spend less time in the store and still make money. But we spend a lot of time planning our futures. One area where I think that most of us as a society, or individuals in today's society, are remiss is not looking at planning on how do we get out of our business. Okay? And if you think about it, we may spend 30, 40 years of our lives building something up, and then we get to the point in time where we want to retire. We have a huge investment in our stores. We've got inventory, receivables, equipment, hopefully a tremendous amount of goodwill. But the point is that when we reach that point in life, we want to be able to convert it into cash, or perhaps into cash. And we also want to be able to pass on as much of our personal estates on to children or other family members, however you want to do it, each individual's particular interest. What I wanted to do is just share with you an example . If you'll bear with me, the slide's a little bit out of focus. But in this particular case, where we refer to client, let's look at that as store owner, and spouse, of course, would be the spouse of the store owner. And just walk through the estate that I think would be fairly typical of what we'd see from most store owners. We have a residence worth $200,000, and it's joint property. The client has $100,000, or the owner has $100,000 in his estate. The spouse has $100,000. In California community property law, it's essentially what the split we'd end up with. In this particular case, there's $100,000 of mortgage on the house. We also have $150,000 in receivables. I look at that as a case of perhaps this owner has had 2 stores, sold an interest in one of the stores, maybe a 50% interest on an IMPC or something, or sold the store outright, has collected a substantial amount of, but still has $150,000 in a note. And I think that happens to a lot of dealers out there. Also have cash and savings. In this case, somehow the spouse ended up with all the cash, and I guess that's sort of typical too, isn't it? but $75,000 of cash. And then really the big asset that we all have in our estates is what? The store, right? Or stores. In this case, we've got business assets worth $600,000 and debt of $125,000. Now, in this particular case, because of the way the assets are allocated between the owner and spouse, the owner has an estate worth $850,000, and the spouse has an estate worth $175,000. The point I want to drive home here is the significant impact that federal estate taxes can have on this type of example. And let me throw it out to you. Any idea how much taxes, estate taxes, would be due on these two estates? Anybody? Todd, you've always got something to say. $300,000. Well, I believe the number that's in the book is $306,000. Whoever had that number, very good. You don't need to go stay through the rest of the seminar. You can leave. Thanks, Guido. But the point is that here's an estate that's worth approximately $1 million. And with a little bit of planning, there's essentially no need to pay any taxes. And with that, I'll turn this over to the representatives from Merrill Lynch that we have here in order. Kip Travis, Ben, and Bruce Williams. So, gentlemen.
Yeah. Thanks for the introduction, John. Some of you may be familiar with the phrase, few people plan to fail, but many of us fail to plan. Estate planning and business succession planning that John just touched upon are important components of a complete, well-conceived financial plan. Ben, Bruce Williams, and I have been offering Merrill Lynch's financial planning service called the Financial Foundation to Big O Tire in Denver. Our intention today is to outline for you the financial planning process as we do it at Merrill Lynch, focusing along the way on estate planning and business succession planning. We like to believe that our process is quite cost-effective and very thorough, and we would be eager to offer it to you if you feel that it could be of benefit to you. It is important to understand that financial planning is a process and not a product. Some of the benefits that you could derive from a financial plan that's been properly done is a greater sense of control over important areas of your financial affairs. You also will receive a written document, a roadmap, which will be available to your financial advisors, such as your CPA, your tax accountant, available to your spouse if at some time you were unavailable for whatever reason. You also should be able to benefit from having just a greater sense of comfort from realizing that some of your family's important needs have been taken care of. But then again, one of the greatest benefits is the fact, because you feel that you have these needs covered, it frees you up to really spend the time where you get the greatest return on your investment, and that's with your business. There are 5 basic steps in the financial planning process. The first one is the organization of key financial data. For example, you would be talking about recent tax returns. You'd be talking about recent statements on your home loan mortgage. You'd be talking about bank statements and investment accounts, maybe your IRAs. We feel that this time of year is probably the most logical time to start the financial planning process because, quite simply, we are gathering much of this data to prepare our 1994 tax returns. So here's an opportunity to turn a pretty unpleasant task into something that could give you some very long-term benefits if you initiated a financial plan. The next step is to identify and prioritize your personal goals. For example, Perhaps you would really like to desire early retirement for yourself and your spouse. The next step is to analyze your present situation. How close am I today to realizing these goals that I just set out? The next step, the fourth step, is try to determine and estimate your future needs. How much do I feel I would like to have in my retirement years to live on? The fifth step is to design an action plan to satisfy those needs, and then to put that plan into action. Also remember that as you go on in time, you need to periodically review and update your plan. What I would kind of compare it to is after you've sold a customer a new set of tires, you would hope that they would continue to have those come back, have those tires rotated, balanced, and have their alignment checked. So you need periodic review. As I said, the first step in the process is gathering information. Today we're going to follow a model couple, Sam and Sally Smith, through this process. Here we've put down some of the basic information on Sam and Sally today, what their assets are, their ages, their children, when their kids might be going to college. Please focus upon the topics that we're talking about and not Sam and Sally's individual situation. That's not the important thing. After we've done that, we can quickly arrive at what their approximate net worth is, like we did on that overhead that John showed. We totaled up their assets and took away their liabilities, and we say their net worth is approximately $900,000. The next step is much more qualitative than quantitative. These are some questions that you have to ask yourself and then try to answer as best you can. Do you have plans for your kids as far as college and where you would like them to go? What do you think about the type of lifestyle you would like to attain and maintain during retirement? Would you like to try to minimize the taxes on your estate? And then if you became disabled, how much replacement income would your family need? Taking the financial information gathered and assembled, along with the direction given by your prioritized goals, our financial planners go to work breaking down and analyzing the major need areas within the financial foundation. Ben's going to cover the first areas, which are income tax analysis and education.
Let's take and look at Sam and Sally's tax summary here. The tax elimination is the most effective way of reducing taxes. There really is no elimination of taxes, as I'm sure you are well aware. But investing in certain tax-free instruments, such as municipal bonds, gives you at least a lever with your investments that can make a great deal of difference. Here we've taken an example of the same $10,000. In one case, it's been invested in corporate bonds, in another case, in municipal bonds. The percentage return is exactly the same. You've got a 6% rate of return, which is pretty comparable to today's rates. On short term, that is out to about 10-year bonds, both corporate and municipal. The return factor in each case is $600 on an annualized basis. But when you kick in the federal marginal tax rate, on the corporate bond, you've got taxes owed of $186. On the municipal bond, none. Therefore, your net investment return is $414 using the corporate, whereas it's $600 using the municipal. In 1993, it took the average American 126 working days. That's the months of January, February, March, April, and half of May just to pay their taxes. And that's why I always take off the last 2 weeks of May to go fishing in the Keys. My wife happens to love it down there too, and I need to think about what I'm going to do for my family the balance of the year, and myself, obviously, because I've now spent the first 4.5 months working for the government. There are many instruments in today's world, some of which you are probably very familiar with, especially those of you who own more than one store and have 25 employees or more. 401k plan is available to you. Most of you might have a SEP. I hope most of you have individual IRAs. But any of these instruments, it's important to consider the differential on earning power between the two. Here we've taken $100,000, put $50,000 into tax-deferred growth in one of the plans aforementioned. The other $50,000 would be just in straight mutual funds in an individual account with no tax benefits. Look at the difference in tax-deferred growth. One case, the $50,000 at the end of 10 years has risen to 90. In the other case, the $50,000 has only gone to 70. I say only, that's not bad. And that's assuming decent rates of return over a 10-year period. As you can see at the bottom, it assumes a 6% growth rate. But the importance here is obviously the bit of tax deferral. Another way to think in terms of, you'll remember we talked about at the beginning we'll talk about the estimated taxes and how that applies. If those of you, and most everybody in there is in business for themselves, as we are, we're basically a private contractor, we've lost a lot of those itemized deductions, especially interest income. Now, why is Merrill Lynch talking about this? There are programs that we have, the WCMA for business owners, and also the equity access availability on your home and second homes, which gives you the opportunity to consolidate debt and still have a tax write-off. I've been asked, as you saw through there and can see in the Financial Foundation, a very important part for all of us is the first step in planning on education. I've been asked to do this, I assume, because though I'm not too much older than Kip, my children are much older than his. And I've spent, one of them's 27, the other's 25, they're through now. But I can tell you, and I thought I was well prepared, what a shock private or state educational planning can be. We just don't know until we go through it. In my case, it was about 3 times what I'd prepared for. So it's very important that you consider this. I'm not going to dwell on it because I think it's something that we're not here to frighten you and get you upset. But here are the differences, and here is what can happen. The rate, you can appreciate this. Those of you who do have college students and maybe are in the 4th year, it increases about 7% a year. And when we were preparing this speech, I know because I've tried to get funding and unfortunately haven't been able to. If combined incomes of $40,000, you've got problems if you're going for financial aid. Well, I read in the journal just last week that has been kicked up to more like $60,000, and there is some relief in some of the new tax bills for those of you with college-age students. But in any case, that's what we are looking at, and it's important that you be aware of these differences in your planning. There's a section in the Financial Foundation which will break down. We do a college builder, there's no additional cost to it, that will help you and get you going in that direction. So now I'm going to turn it back to Kip, and he will get into other steps.
One of the key components of any financial plan is a retirement needs analysis. Key questions that need to be asked in order to produce meaningful results are, at what age would I like to retire? What different income sources will be available to me during my retirement years? How much will I need to accumulate to retire comfortably? And then finally, as we are living longer and longer, we have to ask ourselves, is it possible that I'm going to outlive my assets, or will my assets outlive me? Going back to Sam and Sally Smith, we see that their intention is to retire in approximately 12 years, and they would like to retire at 80% of their current income, which is $120,000. I would like to retire with $120,000. Now, the sources that they are going to call upon during retirement for income, they're going to have Sam's pension, they're going to have Social Security benefits, they're going to have income from their investments, and the possibility of liquidating certain assets to meet some of their retirement needs if necessary. And we realize that it's quite possible for many of you, in terms of retirement planning, that the liquidation or disposal of a store might be very important into how you calculate your eventual retirement. Now, what we do within the Financial Foundation, we total up their different sources of retirement income, his pension, his investment income, Social Security benefits. We take out their anticipated expenses. Those normally run about 60 to 80% of their current income. And then we're able to track each year whether they are going to be in a deficit or a surplus. Now, in this particular example, we see that in the first year of retirement, they're probably going to have to do some restructuring because they are in a deficit, and after about 12 years, they've pretty much exhausted all of their assets. What type of options do they have? Well, one of the good things about this Financial Foundation is we can do a lot of, if you will, different what-if scenarios. Before I get into those options, though, I'd like to point out that in the majority of the financial foundations Ben and I have done for our customers, we find that our customers are really a lot closer to reaching their goals than this particular example is. Here are some of the options that they have to consider. First of all, they could retire at the ages that they would like to, but they will have to have a reduced lifestyle. The second option is to postpone retirement for another 5 or 6 years until they have reached they've accumulated enough assets to produce the income they'd like. The next option is to reevaluate their savings and spending habits and decide that they have to save significantly more than what they have been. The next option is to invest more effectively, trying to achieve higher returns. And then the final option is a combination of 3 and 4, saving more and investing more effectively. One of the things that our foundation does is we try to identify problems and provide solutions. And this is a solution that we came up with for Sam and Sally. They already have been saving $15,000 more than what they've been putting into their IRAs and their 401ks. But they've been saving that outside of those plans. If they took half of that money, $7,500, and put it into a tax-deferred vehicle, like Ben was talking about, such as a tax-deferred annuity, and they were able to increase their return, invest more efficiently, get another 2% return, they would be able to retire at their desired ages and have that desired level of income around $120,000. So we were able to find a suitable solution for Sam and Sally.
Okay, in my opinion, a classic misconception in financial planning is a principle that I think when I look around, and many of you here are at least in my age bracket, 10 years give or take either way. Some of you are luckily younger. But what we have heard, and it's been drummed down through the years, whatever you do, never touch your principle. I'm not too sure that I wholeheartedly agree with that. We are here to make money, spend time with our families, and have fun. And if you've invested effectively, using some of your principal in your retirement years to do the things that you want to do is your option. And obviously, the biggest asset that most of you have in there is your business. So as we go through and go further, and we talk about asset allocation, please keep in mind, we realize that maybe you don't have the capital now to do what you want to do in the future. But it is still important to do some preliminary planning. Because even for those who want to spend it all, most want to leave something to their heirs. And we're really fortunate today. Bruce Williams is with us in the Denver office. He's our regional estate planning coordinator, and he spent more than 20 years in the insurance business. Don't get nervous. We're not going to push product and talk about all the great things that can be done along those lines. But I'd like for Bruce to take it here and talk to you about estate planning.
Thank you, Ben. Appreciate being here with you today. I'd like to accomplish three things in the short time that I have with you. One, I would like to talk about business succession planning and the event the death occurs. The second, how you handle that in the perspective of the estate planning and minimizing the taxes that will be due upon your estate. And third, some general considerations that you can take into account in the estate planning area with a few items just as a checklist of things that you should plan to do. That's always more costly in that type of a situation. The second thing that I would like to do is talk about the estate planning arena. I'll save the business succession until after we go through the basics of estate planning. I'd like to tell you the provisions that the tax law allows you to have, and then we'll try and put that in a case study setting and see what difference it makes in your estate planning. There are three things that the tax law provides. The first is called the unlimited marital deduction. The unlimited marital deduction says that a husband and wife can give as much as they want to each other during their lifetime or at death with no tax. So at my death, if I say everything goes to my wife, there's no estate tax or income tax or gift tax in that process. She would receive everything with no tax. That provision was put in the tax law back in the early 80s as a response to business owners, farmers, and ranchers, because there was a tax established at the first death before that, and they felt it was very unfair to business owners that they would have to pay a big tax just to have the family continue running the business. So that's a very important provision of the tax law, unlimited marital deduction. So it says that there wouldn't be no tax due. In this situation here with Sam and Sally, the net worth we're using here is $1.2 million. So at Sam's death, if he uses this unlimited marital deduction, everything goes to Sally, and as you can see in the boxes on the left, that means that Sam's estate is zero and his tax is zero. So we save tax by using that unlimited marital deduction. However, that may not be the most appropriate thing to do in the long run, because you see down here at the bottom in the green box, the estate tax is $243,000 then at Sally's subsequent death. The second provision of the tax law is called the unified credit. The unified credit is an amount of assets that will not be subject to the tax. Currently, that is $600,000. So when we get to Sally's estate, there are two things that I want to point out here. Sally's assets plus Sam's estate, $1.5 million. Now that's before we net out the mortgages on their home and any other debt that they might have in their estate. But that figure is important, particularly for people from California, because there's two issues you have to look at. One issue is the estate tax, and that's just the tax. The second issue is the cost of probating an estate. Those costs can be as much as 4, 5, or 6% of the value of your estate. And that's the value of your estate before they net out the mortgages. So that's the $1.5 million figure. Now, there'll be some things we talk about as to how you can reduce that expense as well. When we get to the taxable estate of $1.1 million, at that point in time, we take Sally's $600,000 credit. We subtract it from the $1.1 million, and we get about a $500,000 taxable estate. The tax rates start at 37% and go up to a maximum of 55% of the estate. That tax bracket will probably be in the 42 or 43% range. So that's how we come up with $223,000. That's about 40% of $500,000. So that's the process of how things occur. What's wrong with that situation is that Sam said, by the way he had everything arranged, in his will he said everything goes to Sally, the beneficiary of his life insurance, his IRA, his annuity says Sally's the beneficiary. So everything the way he had it arranged said that he did not want to use his $600,000 unified credit. If Sam wants to use it, he has to say so. The way he says it is either in his will, or most of the time in California, the planning the attorneys use what's called a living trust. They set up a living trust, you transfer your assets into the living trust, you actually have to change the title of assets into the trust, and then we do two things. Number one, the living trust avoids the probate expense. So now there's not going to be any probate expense in death. The second thing that occurs is at Sam's death, we take his $600,000 credit and we split the trust up into two parts, an A and B part. There's a lot of different names for it, but we take Sam's $600,000 credit and we have that, it says trust in the black square of $600,000. From that side of the trust, Sally can take all the income and she can use principal if she really needs it. So we haven't impaired Sally's security from that $600,000, but technically that $600,000 will not be in Sally's taxable estate. The balance goes into the B pocket of the trust, and so Sally's taxable estate is now $601,000, which means that she now has a $600,000 credit, so her taxable estate is $1,800. It's very minimal. Her tax is $678. What was it on the previous slide? 240. Substantial savings just by having the proper legal documentation, so each person has a $600,000 credit. Now, the third provision of the tax law is the ability to make gifts. You can give $10,000 per person per year to as many people as you want to. And we use that to get other assets out of the taxable estate. One very good thing to get out of the taxable estate, if your figures are bumping up at the $1.2 million level, and you need to do some further planning, is to take your life insurance and get it out of your taxable estate. All you have to do is set up another trust so that you can now gift the life insurance into that trust. If you own term insurance, either as a company benefit or on your own, what's the cash value of term insurance? Zip. Easy thing to give away. There's no value in giving it away, but you can get the face value, $200,000, out of your taxable estate very easily. That trust operates basically the same way the $600,000 trust operates. The death benefit goes into that trust. Sally can take income, automatically can use principal for health maintenance and welfare is usually the phrase they have. So it doesn't impair Sally's security, but now we have protected $1.2 million worth of assets plus all the life insurance that you want from estate tax. So now we're getting up to some meaningful figures. Beyond that, there's going to be a tax due. So the question is, what else can we do to solve that tax? So earlier we had an excellent presentation on the limited liability companies. Many people are establishing those companies primarily for the reason of estate planning, because it's an easy thing to give. You can put the business in a limited liability corporation, you can give away shares of that company without giving away any income, without giving away any control. So what a perfect way to give. Many people say, I don't want to give things to my kids because they'll spend it now. Well, they can't spend that. So that's a perfect way to start gifting out of your estate to the next generation without losing income. So there's a variety question in the back.
When you give something, receiver who receives the gift, they have to pay tax on it?
The question is, if you give something away, does the recipient have to include that in income tax? And the answer is no. That's a gift, an inheritance, but either way, there's no income tax to the person who receives that. However, if you gift an asset away, the person who receives it maintains your original basis on that gift. So if it's sold at some future date, they would owe tax on the gain if it was sold. But in a limited liability company, that most of the time doesn't occur.
About $10,000 per person, is that given with after-tax dollars, or do you have to declare that income?
The question is, the $10,000 that you give, is that with after-tax dollars? It is not income tax deductible to you, all right? So you have to use after-tax dollars, you give that away. It is an estate planning technique, not an income tax planning technique.
How about the recipient? Did he declare the tax?
No.
No, he doesn't pay any on top of that.
It is not. Now, if you give over $10,000 per year, then that person's still doesn't have any income tax ramification, but it either uses up your $600,000 unified credit, or you have to pay a gift tax. The gift tax is the same as the estate tax. Many people today are actually giving away their $600,000 credits. If the tax laws change in the future to lower that, then they've had the value of giving away those now. That's how we work with our clients in determining what's the appropriate step for your situation and your details that you have. But very simply, it's possible to save taxes on most of what you have. If it's not possible because the net worth exceeds all of these limits and you can't give it away fast enough, then it's possible to use this life insurance trust that you set up to provide the insurance for Sally, to set it up to protect the assets in the estate. We actually use what's called second-to-die life insurance, which is our life insurance there, where we insure a couple together because that's the least expensive way of buying insurance, because the taxes due when the second person dies, and that's when the death benefit of the life insurance insures. So there's some other techniques that we can use. The last thing is on the business succession planning. Part of what we help you go through in this financial planning process is determining what your objectives are. What do you want to happen to this business? The biggest asset in your estate. What do you want to happen to it? You have children that are working in the business now. Are they going to continue running the operation? You have a key person there that would continue running the operation. You have to decide what you want to do, but then you have to make sure that it will occur. If a key person is going to run that business, do you want to have your family security dependent upon that individual? If not, then you need to have what's called a buy-sell agreement. So now the family has the cash, and that person has the business. The person can do whatever they want with it, but the internal control problems won't be a problem for your family. You can protect for that by having a formal buy-sell agreement. If you want the family to maintain the ownership in the business, then you have to make sure that you've provided liquidity for the estate. I don't know how many of you remember Joe Robbie, the former owner of the Miami Dolphins. Why did the team have to be sold? Estate tax. They had no liquidity. Had to sell the team just to pay the tax. What a shame. I don't know how many of you remember Malcolm Forbes. Malcolm Forbes did not have, his son did not have to sell the fortune, the Forbes empire. Reason? Because they had provided for liquidity in the estate by using insurance. They had to pay the tax. They could run the business. So that's what we help you go through in the planning process. First time back over to Skip.
The final topic in the Financial Foundation is a discussion of investment planning and asset allocation. This covers how do I deploy my investments to reach my goals, for example, retirement or estate preservation. Assets are the means to accomplish your goals and objectives. How do we go about creating an action plan to best utilize these assets to attain our goals? There are basically three major questions that have to be asked and answered. First of all, what are your personal investment objectives? Is it long-term growth for retirement? Perhaps you've accumulated most of your assets and now you want to try to maximize your income. So income might be your primary goal. Capital preservation might be of greater concern to you, holding on to what you've built, than, let's say, income or further growth. The next question that a person has to determine for themselves is, what degree of risk are you willing to accept? Are you very risk adverse? I mean, what are we doing here if we're risk adverse? Are you a moderate risk taker, or are you very aggressive? And this is a question that you have to be, to me, I call it taking your own temperature. You have to be very honest with yourself and say, what am I comfortable with? You know, when is my stomach going to start talking to me? For example, in 1994, it was a very bad year for bond investments, and it was a difficult year for stocks in international investing. And a lot of people, after 2 or 3 quarters of below expected performance and returns, some people who were pretty experienced started asking themselves, did I really take more risk than I was willing to accept? So it's better to ask these questions going in than on the backside. Then finally, what is your investment time horizon? Is it relatively short, 3 years or less? Intermediate, 2 to 5 years? Or is it longer term, 5 years and out? That also is important because if you really are trying to be a growth-oriented investor, you have to have a time horizon out beyond 3 years, because a lot of growth strategies don't have a chance for real performance if they don't have 4 or 5 years to work. In the Financial Foundation, we go back and we review people's current asset allocation and see if there needs to be any revision. With Sam and Sally, their current allocation is on the left and the proposed is on the right. And what we've done here, based upon their time horizons, their risk tolerance, and their given objectives, we have suggested they reduce their cash and increase the equity portfolio part of their asset allocation. Asset allocation merely refers to how much you are dividing into the different asset classes, cash, equities, or bonds. But this is a point I'd really like to emphasize. Proper asset allocation, long-term studies show proper asset allocation between cash, bonds, and stocks is responsible for over 90% of a portfolio's long-term performance. It's much more important than, for example, individual stock selection. Finally, we'll finish up talking about risk and return. The yellow line is the proposed allocation we came up with for Sam and Sally, about equally balanced between stocks and bonds and some of their cash. This allocation significantly, going back to 1982, it significantly outperformed inflation and the return on cash, and it pretty closely tracked what an all-stock portfolio did. But the big benefit from diversification, the fact that they had a good portion of their assets in bonds as well as stocks, is the yellow line did not have nearly as many severe ups and downs as the portfolio, which is made up the S&P 500, an all-stock portfolio. So you can see that by having those bonds in there, it diminished the volatility and lowered the risk. So that's the point that we want to make about diversification. And I'll give it to Ben to finish up.
I always worry about this kind of a seminar. If I was sitting there thinking, why in the world did I come to a convention to be frightened and intimidated? And that's not our purpose. You don't need to be frightened and intimidated. Obviously, you wouldn't be here if you weren't successful, goal-oriented, and you've done some pretty good financial planning on your own. We're merely here to show you a process or a roadmap that you can use and to augment what you have probably already accomplished in a pretty good way. We're also keeping in mind you make your asset as your business, will probably continue to be your business, and we would like to see those businesses stay in the family and do what you want them to do. No, I do not. I've been with Merrill Lynch 23 years. Kip's been here 20. Bruce has been in the insurance business well over 20. Kip and I formed a partnership about 8 years ago because this financial marketplace had become too complicated for one person to try and comprehend and understand. I'm not sure the two of us always comprehend and understand, but we have experienced most of the pitfalls. We would welcome the opportunity to work with you. The question probably becomes, well, gee, I'm in California. These guys are in Denver. How can they be of help? I started with Merrill Lynch in California. Always kept my license there. Get back fairly frequently. But once a process is undertaken, most of it is done on the phone anyway. Included in your books are our 800 numbers. There's one thing I'd like to change. The direct line there was the direct line of an assistant that we had. That's been changed. And the direct line is 446-5557 or 446, that's my number, 446-5682 is Kip's. But the 800 is what all you people should be using. And we also have individual 800 numbers, which if you want to come by, we'd be happy to show to you or give to you. So we're not hard to reach. we can handle it from Denver very easily. We really appreciated the opportunity to be with you, and we thank John and Steve for allowing us to do that. We will be here the rest of the afternoon, and all the information, if you'd like to stop and see the finished product, it's in our booth, and we promise we won't push any mutual funds or stocks and bonds at you. Thanks again.
Okay, that pretty much wraps it up. One last thing I would like to say about these gentlemen from Merrill Lynch. I've had a chance to work with them personally, and I'll convey to you my personal experience. Estate planning is not something that I run home to do every night saying this is the most exciting thing in the world. And I think most of us are probably in that same boat. This is something that we'd prefer not to think about. Once we set our minds to it, that we do want to do something, then the process starts. The thing that I've seen demonstrated first and foremost from these three particular people is they will, if you accept the expression, drive the process for you. They'll be on the phone saying, you need to do this, you need to do this, you need to do this. And they help you through each step of the process. If you need to have a will set up, they'll contact an attorney for you. They'll help you. They'll sit in on the meeting with you. So it's those types of services that they offer, and I guess it might be the premium, what would you say, estate planning services similar to our premium tire service policy. Enough on that. We've got a 15-minute break, and then you're on to the next.